Most people spend decades doing everything right, planning for retirement, saving consistently, investing wisely, staying the course through market downturns, and building something real. And they get to retirement and discover that a significant portion of what they built is going to go to taxes. It's not because they made mistakes, but because no one ever showed them how to structure things differently. And here's what makes this very frustrating: the tax code is full of legitimate strategies designed to reduce what you owe in retirement. Most people just never learn they exist, let alone understand how to use them effectively. So that's what this video is all about. I'm going to walk you through 5 strategies that can potentially save you thousands or tens of thousands of dollars every year in retirement. Some will be straightforward, some are a little bit more advanced, and show you how they fit together in a complete approach. I was sitting recently with someone who had about $1 million saved for retirement. They felt confident and they had thought that they had put the hard part behind them with saving all this for retirement. We ran a simple projection of how their income would be taxed for the next 20 years. And what they assumed was going to be roughly a 15% tax situation was tracking more like a 25% or higher level for decades to come. Nothing had actually ever gone wrong, but no one had ever looked at how their income was structured. Same money, same retirement, but completely different outcomes based on the planning alone. So there's 5 strategies most retirees never use. And once you see how they connect, the whole picture looks very different. So let's go through them one at a time. Strategy 1, let's understand to control what shows up as income. This is where everything starts, because taxes in retirement aren't based on your net worth or your account balances. They're based on what shows up on your tax return as income in a given year. And not all income is treated the same way. A withdrawal from a traditional IRA or 401k counts as ordinary income, fully taxable at that marginal tax rate. A withdrawal from a Roth IRA, assuming the account's been open long enough, is generally tax-free. Drawing on after-tax savings or a taxable brokerage account often has a much lower tax impact depending on what's inside it. Most people never think about this distinction. They withdraw from whatever account is most accessible when they need money without considering what that withdrawal is going to do to their tax picture for the year. Now, the more deliberate approach is to design your income sources before you need them. Now, this is so you'll know in advance which bucket to draw from, in what order, and what that means for your taxable income each year. This kind of intentional sequencing is one of the most powerful tools available to retirees, and most people never use it. So understanding what will be taxable income each year is very, very critical to making this wise decision. Step 2, understand tax brackets and how to use them deliberately. So here's a concept that changes how most people understand and think about taxes. In the US, we have a progressive tax system. That means you don't pay one flat rate on all of your income. You pay different rates on different portions of it as it moves through the brackets. Income up to a certain threshold is taxed at a lower rate, and only what gets above that threshold gets taxed at that higher rate. So what that rate creates is an opportunity to be intentional about how much taxable income you recognize in a specific given year. So if you're in the 12% bracket today, but you know that required minimum distributions and Social Security will push you into the 22% or 24% bracket later, the question becomes whether it makes sense to voluntarily recognize some income now with a Roth conversion at the lower rate rather than being forced to recognize it later at the higher rates. This is often called running the brackets. It's not about paying more tax than you owe. It's about choosing when you pay this tax so that over your lifetime, the total taxation would be lower. So strategy 3, strategic Roth conversions. This is one of the most widely discussed strategies in retirement planning and also one of the most commonly misunderstood. A Roth conversion moves money from a pre-tax account into a Roth. You pay tax on the amount converted in the year that you do it. That money then grows tax-free and can be withdrawn tax-free in the future. There are also no required minimum distributions on Roth accounts, which gives you more control over your income in later years. The concept is simple. The execution, though, is where it gets very nuanced. Converting too much in one single year can push you into a higher tax bracket. It could cause more of your Social Security to become taxable, or also trigger higher Medicare premiums through the IRMA adjustments. The goal isn't to convert as much as possible, it's to convert the right amount in the right years at the lowest possible tax cost. The window that tends to offer the greatest opportunity is the period for folks between retirement and the age where those required minimum distributions or RMDs begin. Usually, those RMDs will be in someone's mid 70s at this point. In those years, income is often lower than it will be at any other point in retirement. So that creates space to convert at favorable rates before those forced distribution and withdrawals start. But this has to be mapped out very carefully, often looked at year over year, and understanding this against your full income picture. So, done well, it's one of the most effective ways to reduce lifetime income taxes. Done without the right precision, it can create massive problems that it was actually meant to solve. Brings us to strategy 4. There's a 0% capital gains rate, and this one generally surprises most people the first time that they hear it. Depending on your taxable income in a given year, your long-term capital gains rate can drop to 0%. Not a reduced level, but actually zero. For married couples filing jointly, that threshold is in the low six figures. And for a retiree who has managed their taxable income carefully, drawing from Roth accounts, timing other withdrawals thoughtfully, it's entirely possible to have a year where their 0% rate could apply. In that scenario, you could sell appreciated investments or stocks that have gained value, realize those gains, and still owe nothing in federal capital gains tax. Some people even use this to rebalance their portfolio at a lower tax cost each year. Others could use it to intentionally harvest those gains that would have otherwise be taxed at higher rates later. Now, this isn't a loophole, it's how the tax code is written, but it only works if your income is positioned correctly, which is why it's connected to everything else as we've discussed. Strategy 5. This is the advanced layer most people never reach. Beyond the 4 strategies that we went over so far, there's a set of tools that most retirees never get introduced to, either because their advisor doesn't work at this level or because they're managing things on their own. So a few of these ideas would include things like the first one as understanding tax location. So placing different types of investments and accounts where they will be taxed most favorably. At times, this could be putting things like bonds or other income generating assets, for example, in things that are more tax deferred accounts, while growth oriented investments that are very tax efficient going into more taxable or brokerage or non qualified type accounts. The second would be the strategy of using capital loss or tax loss harvesting ideas, which allows you to offset realized gains with losses, reducing your tax bill every year, and even be able to offsetting a little bit of your ordinary income. So again, tax loss harvesting allows you to offset realizing gains with losses, and this could reduce your tax bill in that specific year. The third is qualified charitable distributions, which allow you to give directly from an IRA to a qualified charity, satisfying your RMD for the year without that amount counting as taxable income. The fourth, a lot of folks have heard about these, is HELP savings accounts. Now, these offer a triple tax advantage that can be strategically valuable in retirement for those who've had those and keep those into retirement. Now, none of these strategies are particularly complicated in isolation, but what makes them powerful, what makes them difficult to implement correctly on their own, is that they all interact with each other. And with the rest of your financial picture, they have to work together in a full integration. So why does this integration actually make this work? Well, tax planning in retirement isn't a standalone exercise. Every decision you make about taxes affects something else. It could affect your Social Security taxation, your Medicare premiums, your investment returns, your income in future years. It's all connected. That's why knowing these strategies isn't the same as implementing them well. The value comes from coordinating them together against a complete picture of your income, your accounts, your timeline, and your goals. This is exactly what we build for clients at Cornerstone Wealth Planning. Not just a list of tax tactics, but an integrated strategy that connects income planning, tax decisions, Social Security timing, and investment structure into one integrated, cohesive plan. If you'd like to see what that looks like for your situation, click the link in the description to schedule your free retirement strategy call, and we'll look at your numbers specifically, identifying where the real value is, how to build your long-term integrated plan. Thanks for watching. I'll see you on the next video.